Welcome to the topic of high interest, high discussion these days, which is GCC setups. That's where much of the hype in the market is right now, right? While some are focusing on GCC transformation as well, but GCC setup is that's making most noise apart from AI, right? So with that, today we'll be discussing four different areas, right? One is we'll be talking about where the industry is right now, how much is the growth, what's happening in the market overall. We'll be talking about what buyers expect in setup deals, how do they build their business cases, the evaluation criteria they have, right? And then we'll quickly jump on to the type of innovations we have seen in GCC setup oriented deals, both build, operate, transfer. And again, there are combinations within that. Then there are assisted build out that happen as well. So, and lastly, we'll be also focusing on the pitfalls that both providers and buyers should be avoiding. There are reasons that some GCCs fail. There are reasons some providers continue to not scale their GCC market, right? And we'll be covering all of that today. So with that, I'll ask Ravneet. Ravneet, can you talk about the industry? It's very exciting times. You know, what do you think is happening right now? Where the market is going?
Thanks, Sachin. As we move on to the next slide, you're right, these are exciting times for the GCC industries. GCCs have actually evolved from being back office support functions to strategic engines, which are not only powering global sourcing, but innovation and enterprise transformation also. What we've seen in this post-pandemic world is an accelerated pace of GCC expansion as enterprises are seeking greater ownership of service delivery and IP alongside tighter governance and risk control. Today, if I just look at the offshore-nearshore geographies, there are over 6,000 GCCs, and the momentum continues to build, with more than 150 setups in the first half of the year itself. If I put that into perspective, the industry has been averaging around 300 setups annually over the last 3 years, and is a clear sign that this sustained confidence in the model continues. Let's just unpack what's driving this growth further. First and foremost, North America remains at the forefront of GCC adoption, driven by the long-standing offshoring mindset and the advantage of English as the single operating language. US-based enterprises constitute over 40% of offshore-nearshore GCC setups. Second, despite macroeconomic headwinds, the TMT sector accounts for nearly 40% of new GCC setups between 2023 and H1 of 2025. Now, these firms are leveraging GCCs not just for cost efficiency, but increasingly for digital, analytics, and AI-led innovation. The third and one of the most interesting themes that we have witnessed more recently is that mid-sized firms and first-time adopters are expanding their GCC base. More than 60% of new GCC setups come from organizations whose revenue is actually less than just 10 billion. And an equal share comes from first-time adopters of this model. So basically, those firms which are setting up their first GCCs. Now, with the ecosystem maturing and the entry barriers reducing, the GCC model is now becoming accessible to a much wider enterprise segment than before. Another interesting shift is the growth of smaller specialized GCCs, or what we call as the nano micro GCCs, often with the sub 100 headcounts, which focus on high value, judgment intensive, and digital capabilities. Now, this is a departure from the traditional large scale multifunction setups, which were aimed at economies of scale. So, overall, if I have to put it in a nutshell, what we're seeing is an inflection point in the global sourcing landscape. Both enterprises and service providers are investing heavily to make the GCC model more agile, value centric, and innovation driven. Moving on to the next slide and looking at the trends across delivery geographies, India clearly stands out as the undisputed leader in the GCC landscape. Over the years, India has continued to consolidate its position as the global hub for GCC activity, and we believe this leadership will continue in the coming years as well. As of the first half of 2025, India accounted for nearly one third of all offshore nearshore GCCs, which is by far the largest share globally. What's more interesting is the trend on the right. India's share of new GCC setups has actually surged from around 28% in 2021 to more than 55% in 2024 and the first half of 2025 as well. So, it makes us think what's fueling India's sustained leadership. And our assessment shows there are four key factors that stand out. First is the abundant and skilled talent pool, capable of managing not just mid complexity but high complexity work as well. Second, the continued cost arbitrage, which remains attractive relative to other geographies, which are now witnessing rising costs, especially in the CE region. A third is a mature partnership ecosystem supported by collaborations between enterprises, providers, and the government. And lastly, the lower barriers to entry. Thanks to a conducive regulatory and business environment, setting up a GCC in India is now much easier than much before. So, together, these factors have firmly positioned India as not just a delivery powerhouse, but as the innovation and transformation engine of the global GCC ecosystem. Now, we see where the industry is today, but where is it going in the future? Where do we see the future to be? As we move to the next slide, let's take a look at the outlook for the medium term. Moving on to the next slide. Our estimates indicate that the overall momentum in GCC adoption is expected to stay strong, supported by multiple reinforcing factors. I'll just start with the numbers which you see on your left. Buyer spend on offshore-nearshore GCCs is projected to reach nearly 155 billion by 2027, which is a whopping 15% CAGR growth over the period. The number of GCCs itself are expected to reach 7,000 by 2027, employing over 4 million FTs. Now, beyond the usual talent and cost arbitrage opportunities, we witness two key reasons that are fueling this GCC adoption. The first is a strong peer driven momentum. Now, as we see more and more success stories of GCC setups, GCCs delivering high complexity work, GCCs driving transformation agenda, it's encouraging more and more enterprises to explore and expand their GCC footprint. And second, like we mentioned at the very start, the GCCs are now taking a far more strategic role. They're helping enterprises drive transformation, they're building innovation capabilities, and they're helping them maintain a tighter control over talent, processes, as well as intellectual property. So while this growth for Outlook GCC remains strong, it is important to recognize that there's still a large untapped opportunity ahead, which is what we explore on the next page. We recently assessed the adoption of the GCC model among the global 2000 enterprises. And interestingly, despite over 300 new GCCs being established every year, nearly 65% of these enterprises still do not have a GCC. And while this number seems significant, it isn't entirely surprising given the various complexities that are involved in setting up a GCCs. So, starting with the very basics, a conservative approach to offshoring. The perceived loss of control, concerns around data privacy and quality often make the leadership term teams hesitant to take the first step itself. Next, the lack of executive mandate or sponsorship is another critical barrier. Successful GCCs typically begin with a strong top down vision and alignment across strategy, technology, and HR. However, what we've seen in many cases, the absence of clear ownership, which might just be due to past experiences or apprehension of the unknown, can delay or derail these initiatives. Work package definition and operating model design are also present major challenges. Many enterprises struggle to determine which functions, which processes should they transition to a GCC. Now, without a well defined roadmap or a phased plan, setups obviously risk being underutilized or misaligned with the business priorities. For first time adopters, which are actually making 60% of the new setups, establishing governance structures, performance metrics, and leadership layers adds further complexities. Now, the learning curve can even be steep, and early missteps often impact perception and momentum. Finally, the regulatory and legal complexities, especially if you're entering a new geography, coupled with limited local market knowledge, add yet another layer of difficulty in building successful GCCs. So, while there is the potential of GCCs, which is undeniable, addressing these structural and execution barriers will be critical to unlocking the next phase of global adoption. And with that, we would like to bring up our first poll for the day.
Yep. No, thank you, Ravneet. By the way, that 65% is a surprise for me. So anyway, the poll is for our enterprise or buyer clients. Simple question. When setting up a GCC or expanding a GCC, what has been the biggest challenge? You're not able to create a business case. challenges with work, you don't have experience in running or managing GCCs, you don't have the local market knowledge, or there are regulatory challenges, right? I'm excited to see what the results would be. I have my thoughts. Let's maybe give it 15 more seconds. And maybe if we can see the results now. Perfect. So not surprising. Limited experience in running and managing GCCs is one of the biggest drivers. Absolutely, yes. We hear that all the time. Complexity with work, lack of local market knowledge. Again, these are all important parameters as well, apart from compliance. Now that brings us to the next section, and we want to talk about what challenges, what expectations buyers have, and why some of these challenges, what they are making buyers do, right? And if you can move to the next slide, I mean, linked to this, right? We just discussed the challenges enterprises face while setting up GCCs. Again, some of the ones which you highlighted included, you don't understand the local market, you don't understand the regulatory compliances, right? Or there are complexities in managing work packets. What this has meant is enterprises or buyers are now working very closely with external providers and advisors, right? Few years ago, 30% of setups actually involved external support. That number today is close to 50%. Our estimates suggest that by the end of this year, we'll be closer to 50-55%. The reason is clear. Providers provide you that support to move faster. It helps you reduce cost and essentially access local expertise, right? Now, within these provider-supported setups as well, BOT or built operate transfer, as we call them, they've become really popular. And this is a wave which has occurred after the Great Recession in 2008-9, right? Right now, roughly close to 40% setups are BOT, right? And when you combine them with assisted build-outs or ABOs, they make up 90% of the provider-supported setups in general. Now, because of this shift, what has also happened is the service provider addressable market within the G setup segment is growing rapidly and is expected to triple in the next 3 years, right? It is close to $3 billion right now. We expect this to reach $9 billion by 2027. Net, enterprises are moving from building everything on their own to partnering with experts who can help them scale faster and more effectively. Now, as we move to the next slide, it lays out a very simple value chain of what are the typical activities involved in a GC setup process, right? Now, as the role of providers increases, as buyers or enterprises choose to work with providers, the role now spans across the entire journey. So what that means is within GCC design, we are seeing a lot of advisory-led providers help shape the model. They're helping shape the scope, the location strategy, right? And we are seeing the ones with particularly strong consulting and market knowledge stand out in this market. Then even within setup compliance, right? We are seeing even SIs partner with law firms, some of the other providers with expertise in this area to support enterprises, right? Now, providers also play a very big or key role in building talent and technology infrastructure, which again forms the backbone of the GCCs, right? And I can go on, right? Infrastructure, facility, technology, everywhere, either the SIs or providers are doing it themselves, or they are partnering with different providers to create that ecosystem, to bring that full power of the ecosystem. So providers today, act as end-to-end partners. They're helping enterprises in designing, launching, stabilizing GCCs with greater speed and confidence. Now, which brings us to the next segment. And Achint, I mean, you and I have worked on multiple such mandates in helping our enterprise or buyer clients in setting up their own GCCs. Could you please help the audience understand what all parameters do buyers face this on?
Absolutely, Akshay. So in our experience, whenever we have worked with buyers, enterprise clients, their program heads, CIOs, there are some questions that go on their mind, and based on that, they are making decisions whether they want to kind of go ahead with, let's say, a build out of operate transfer, they want to do an assisted build out, what kind of a build out they want to do, which location they want to do, right? And then effectively what the structure of that GCC is going to be. So think about the facility. right? I mean, if you think about a build, operate, transfer, eventually they kind of have the facility, the assets, everything else transferred to them. So they make a decision if they want to have a OPEX based view to it, or if they want to do a CAPEX upfront assisted build out, owning it entirely on their books, right? So that's where the facilities question become very important, that how does the facility that they will set up as a GCC would kind of align with the global planning or the global real estate strategy that they have. Then when it comes to the technical infrastructure, it's about if they import versus if they kind of buy local. When it comes to hardware, servers, their different platforms. In regards to hiring and performance, what kind of hiring ATS solution that they implement, or in terms of when they want to transfer, what exactly would be the strategy to transfer, whether this will be big bang or whether this will be phase manner, right? So net of it, we are seeing that typically GCC setup is not similar to outsourcing. Again, going back to the outsourcing, typical outsourcing deal, even some of the largest one, we have seen that that in terms of user persona, there are some 2 or 3 different user personas involved. There is the CIO, there is the IT director, those kind of 2 or 3 different major personas involved. But in a GCC setup, however, we are seeing at least 9 to 10 different personas being involved. So there is a risk leader, there is an HR leader, there is a CIO, their IT director team, there is someone who is part of the real estate strategy, global real estate strategy for that firm. So again, the process becomes fairly democratic in nature, but it also becomes really complex because there are so many work streams involved, right? When it comes to making a decision. I would also like to kind of cover on the next page that how is the business case getting impacted because of all of this, right? So if you think about any RFP that today comes to, let's say, a service provider or any kind of deal that goes out, a lot of times what we see the providers may have visibility is only the outsourcing services component, which is showcased in the blue format in this page, right? But usually when the overall business case is being built, a client is typically looking at all the other factors as well. They're looking at the in-house outsource mix, whether they'll set up the GCC with only outsourced contractors or whether they'll have, let's say, their onshore team work also being moved in the GCC itself, right? How much will be the productivity drag? Because there is a whole transition process that happens, right? Incumbents who have been sitting in the system for 20-25 years now will suddenly be transitioned out. Then how do you maintain that knowledge in the system? So again, many other factors, expat travel, what kind of mobility taxation they'll have to build it out. If there is an exit that is planned, let's say if things don't turn out well, and if they have to make an exit, then what kind of exit costs are involved? How much is the wind down cost involved? What are the tax implications? How do we ensure that the arm's length pricing, arm's length so that the taxation is minimized can be maintained? What kind of branding activation costs will be entailed when it comes to setting up the own GCC? Because in a lot of cases, the Indian talent may not even know the brands. So net of it, when it comes to building that business case, there are so many factors involved that all of these need to go into the business case when they're being built out, right? And that's where we always see that a lot of clients may not have the entire picture of what all thing they need to envision for. And usually the business case starts getting broken at that point, as things advance and they come to know about more cost. Next, we talk about the 3 broad models. This one here we talk about there are primarily 3 models, but the market today understands. There is BOT, which is build, operate, transfer. There is assisted build out, which is also known as assisted captive setup, and then there are the JVs, which is joint ventures, right? As of today, Akshay, correct me if I'm mistaken, but BOT and assisted build out are the top 2 ones, right? That's where we are seeing most of the adoption. Joint ventures, not so much, right? Very, very low single digit percentage figures. In terms of the buyer favorability, as in how much it is in favor of buyers, if you think about the BOT setup, again, in terms of extent of ownership and management control, not so much, because in this case, typically the provider initially creates the overall strategy, they hire the resources, it's on their payroll. It is only after a certain time that the buyer has a control over hiring who they want to, right? In terms of assisted GCs, however, you have control from day one. But then what we have seen, Akshay, again, Ravneet, is that people are not always comfortable doing an assisted GCC setup. Especially, I'm seeing that happening in the regulated industry, right? Especially in banks or any insurance firm. Those are the ones who are going with the BOT. because it's of the unknown. While if I think about any of the CPG firms or any other sector like automotive manufacturing, that's where we are seeing more and more of assisted GCCs happening, right? Again, examples are both ways. Even in banks, there are assisted GCCs happening, but extent of ownership, management control, all those kind of factors decide a lot in terms of which of the models the clients are looking for. With that, we will go to a complementary CTA. Again, CTA means click to action. For our buyer enterprises, today we are making an offer, which is if you're interested on any of the 5 listed topics, which is either of real estate strategy, talent acquisition, cultural alignment, transition and transfer, or program governance, one of the topic, if you want a complimentary briefing with one of the analysts from Everest Group, which includes the 4 of us or anyone else, we'll be more than happy to do it for you. Right? Again, making it clear, it's only for buyers, only for enterprise stakeholders. All right. With that, Ravneet, we are seeing again adoption, but can you talk about how the expectation when it comes to setup is evolving?
Thanks, Sachin. Again, a very interesting question indeed. So, a few years back, enterprises setting up GCCs were, like we mentioned, primarily focused on cost and talent arbitrage. But now, with the strategic importance of GCCs continuing to evolve and the business and macro environment growing more uncertain, we're seeing a clear shift in what enterprise leaders expect from their provider partners when they're establishing GCCs. Now, one of the primary themes emerging from our recent conversations with our clients is that when they're setting up a GCC with a partner, they want it to be a strategic partnership, one that closely aligns with their long term vision, their priorities. Providers or partners are no longer seen merely as implementation partners, but as strategic enablers in the journey, helping them build future ready GCCs that are fully aligned with the business objectives. From debating the need for a GCC to defining work packages and designing the overall operating model, advisory and consulting led support has now become a core component of provider assisted GCC setups. Second, with a stronger focus on GCCs driving enterprise wide transformation initiatives, next generation technology is emerging as a core pillar and not just a value add. A lot of the enterprises that we've discussed more recently with, they expect digital transformation and next gen technology solutions to be embedded within the GCC's design and solution right from the very start, rather than being introduced later as enhancement. Another key theme, and in fact, this is one of the hottest theme that we see across all RFPs or all deals that we've been supporting on, is the need for cultural alignment right from day zero. Now, enterprises today expect their GCCs to operate as true extensions of their headquarters. Not just, and this is not just in terms of policies and practices, but in every aspect of employee experience. This includes ensuring the real estate design, workspace fit outs, and the overall culture are a mirror image of the parent organization, creating a seamless and unified identity across locations. Next, flexibility and risk mitigation have also become top priorities for enterprises, especially for those which are setting up their first GCCs. Organizations today seek clarity in scope, transparency in execution, and flexible transfer options, ensuring that contracts and pricing models include well defined safeguards to protect the enterprise's business interest first. In a sense, what we're seeing is a fundamental redefinition of enterprise expectations from the GCCs and provider partners. Enterprises today want partners who can help them envision, who can help them design, who can help them operationalize GCCs that are truly future ready. No, these centers that do not only deliver value, but also advance the enterprise's broader agenda. Let's move to the next slide and have a look at how these evolving expectations are translating into on ground requirements across the different buyer personas that Achint had previously mentioned. What we're increasingly hearing from enterprises is that alignment with their global standards and procedure is expected right from day one. This alignment span across multiple work streams from HR to finance to IT, infrastructure and operations, ensuring that the GCC truly operates as an integrated extension of the parent organization. Let's just look at a few examples. In HR, the focus is on ensuring strong cultural alignment with the parent entity and establishing structured change management roadmaps to ease the transition. In finance, enterprises expect their partners to have expertise in GCC specific transfer pricing and intercompany financial structures, ensuring compliance and transparency. For talent ramp up, which is a key criteria for a lot of enterprises, agility is the key, with GCCs expected to scale up or down quickly, aligning talent strategies with enterprise skill roadmaps and building dedicated recruitment and onboarding capabilities. On the IT and infrastructure side, buyers expect a lot of plug and play models aligned with the global standards, along with robust end user support to ensure a smooth operation. Under facility and operations, like I mentioned previously, the expectation is to design future ready modular spaces that can expand easily and mirror the look, feel, and layout principles of the headquarters. And finally, risk and compliance, which continues to be a top priority, with buyers looking for layered business continuity framework as well as proactive assessment and mitigation plans built into the operations from the very start. So, overall, enterprises are no longer looking for basic operational readiness. They expect day one alignment with global processes, standards, and experiencing, ensuring that GCC operates seamlessly within the broader enterprise ecosystem. Achint, what are your thoughts on how these change in expectations, will lead into how we're seeing engagement models and pricing strategies to evolve?
Yeah, I mean, a lot, right? We do expect things to change significantly, right? And if I think about the overall alignment that needs to happen right now. Okay, now if we think about the next one, which is innovation in GCC setup deal, I think this is very important because again, the hype is all there. Everyone knows what's happening. GCC setups are happening right now. All of that kind of stuff. I think there are four different parameters that we look at on the next page, which are more about, first of all, the type of evolution and engagement models as we see unfolding, the way solutioning is being done differently, right? What are winners doing, how they're doing it differently, and it of course go to their overall value prop, the whole model that they've built based on their core expertise, how pricing is being done for the GCC setup, again, factors that influence that pricing. And lastly, the contracting part of it, where we talk about the SLAs, KPIs that we see across different phases. So with that, I'll have my colleague Manish. Manish, what do you think is happening? How are the engagement models changing?
Yeah. So if we go to the next slide, and let me just take a step back from the icons and summarize what we are seeing in the market, from an overall engagement model standpoint. So what we see is that models are breaking into smaller targeted positioning. Now, alongside an end-to-end deal, providers are also packaging PCs that match the buyer's maturity and the overall needs. Now, an outcome of that would be GCC as a service model. Now, it's basically an a la carte model wherein the buyers may choose the specific support that they may require, be it in terms of entity setup, tax, payroll, recruiting. Now, from a prevalence standpoint, it typically shows up with the buyer that already, have some idea about how to run a GCC or just want limited and targeted execution. Right, and this is often bundled with a light governance layer so that the individual services they are cleanly connected. Secondly, talking about extended hand-holding and white glove services, this is model we are seeing for first-time and small to mid-size buyers. Now, herein, beyond the typical end-to-end support of a BOT or assisted build-out model, providers are going beyond and providing support such as mobility services, simple visa applications, playbooks for HR, landing team, site selections. Then we are also seeing, interestingly, that bot is being reframed as a capability builder. Now we see an increased focus with time box BOTs for specific goals, such as maybe setting up a data or AI COE, or as simple as ramping up AI specific roles in a particular GCC, and then transferring ultimately when the milestones are met. Now, this ultimately may also take shape of a BOTT model, which is build, operate, transfer, and transform, wherein the transformation precedes transfer. Now, net providers are aiming again for faster outcomes and offering more choice, and they're adjusting proposals to match the overall buyer needs based upon the overall maturity. Now, how this links to the overall changes in the solutioning is something we talk on the next slide. Now, what we have seen is providers have become more proactive and flexible in solutioning their setup deals, which again at the back end are driven by the evolving engagement models. Now, importantly, this behavior is not just limited to few elements, but we see this across the deal cycle. Now, for example, if we talk about the design phase, now what comes to the forefront are the pre-configured playbooks, which covers the entire scope spectrum. Earlier, which was limited to primarily enabling services such as finance, HR. Now, leveraging of partners with their specialization such as real estate, hiring, taxation, they do not just increase the buyer confidence, but based upon our experience, they also improve the overall strategy. Now, this is further augmented by the involvement of SMEs from diverse fields, such as people who have GCC run experience, the industry expertise, such as BFSI healthcare, functions and scope. From build phase perspective, what we are seeing is accelerated deployment, as we talked about in the previous slides. Again, it's a common theme that we see in the proposals to kickstart the operations, which is essentially a usage of a warm shell facility with your basic redesigning to ascertain the look and feel of the center as per the parent guidelines by the time the new facility is being built. Now, from an operate perspective, we see providers proposing or being more open to an accelerated ramp up. This is also supported with maturity linked metrics, keeping the buyers right to hire open and plug in third party solutions for a quicker deployment. Now, this showcase flexibility is also flows on the one of the most debated phases, which is the transfer phase, wherein we not only see a proposition for phase transfer, again, it could be by function, size, department, but also by the timeline of transfer as well. Now, in a few cases, we have also observed that the transfer began as early as 18 months because buyer wanted an early control. Now, what it essentially helps is one, to avoid any exit dispute, second, lift the overall buyer experience, and then strengthen the provider's reputation for clean transitions, especially. However, post-transfer, they keep on supporting on primarily on the non-core areas and primarily via extension to their IP. This basically creates a steady annuity revenue, lower churn, and further room to upsell advisory and enabling or ancillary services. Now, consequently, on the next slide, we see a dynamic play on the pricing as well. Now, an interesting mechanism is the hybrid model in an engagement, wherein just imagine that design is charged as a fixed fee model. However, the core service delivery is charged in a rate card model. And at the same time, the fee for the enabling function could very well be charged in an entirely different model, such as per FT model, right? Now, further, depending upon the duration of the operate, typically in deals with operate phase lasting greater than 3 years, and as well as the overall scope and size, we also see that providers agree to not charge any transfer fee as well. Now, with earlier used to be somewhere in the range of 10 to 15%, that is being waived off. Again, to further simplify the fee structure, we are also seeing an increased proposition for IP-led inclusions, which is basically a proposition of a common fee for both services and tech so that the overall model is simplified. Now, as we step into the Gen AI and agentic AI era, which again at the core of any transformation initiative, buyers, even in GCC engagements, they are looking for a clear ROI and tangible benefits, including the timeline at which these benefits would be realized. This is true especially for a BOTT engagement, that is build, operate, transform, and then transfer. Talking about labor, non-labor investments, you can basically think of them as a financial engineering mechanism wherein providers offer certain services such as marketing, branding, extended advisory services, usage of any IP at no cost. Now, to sum up, net price positioning, we have seen it play a very critical role if providers are able to articulate the financial value of an engagement, tying back to the overall business case that we talked about. Lastly, in the next slide, we talk about that flexibility does not really stop at solution and pricing. Negotiations around the contractual TNCs in recent times, we have seen them to be stricter, and usually the transparency that providers bring in the proposals and during the contracting stage, it ensures the smoothness. Now, from allowing buyers to exit anytime they want to, and then contractually agreeing to it has been a differentiating factor. This basically involves assessing a fair termination fee, again, if applicable, and its relative apportionment to multiple cost elements. Further, to ensure that buyers have maximum visibility both pre and post transfer, providers have also been presenting a true cost up, which is nothing but an increased transparency into various cost elements such as pass-through charges, salaries, any margin on third-party solutions. Essentially, for what all areas such as advisory or service delivery would a provider provide transparency and to what extent is the key. Additionally, to ensure that provider is performing and delivering as per the plan, we see an increased inclusion of program level metrics across phases with a clear articulation of the applicability of financial penalty for each of the metric.
Perfect. So that brings us to the next poll on the next slide. Thank you, Manish, and really insightful. Now, this poll is for both enterprises, buyers, as well as providers. Again, slightly controversial question, but essentially, what are those areas which often spark strong discussions, right? Again, performance-linked fee at risk, termination clauses, cost true-up, program metrics, and risk and regulatory compliance. Let's give 25, 30 seconds and let's see what people think. And again, as I said, this is for both enterprises as well as providers, right? Look forward to hearing what you believe. Interesting answers. I mean, I would have expected cost true up to be a big driver, but and maybe we can close the poll in 5 seconds. Yeah, so performance linked fee at risk, very fiercely debated of okay. Termination, including exit options, again, a big driver, right? And cost true up as well. So again, multiple things, right, which we discussed here. So now, what does that mean, right? And we have seen, and as we move to the next slide, as we've discussed, which contract terms spark the most debate. Let's try and understand how both sides can ensure alignment once a deal is signed, right? So, for example, once a deal is signed, success really depends on how clearly both sides agree on what will be measured. The most successful setups are the ones wherein providers and enterprises track progress together, right? Now think of this as a journey, right? So for example, in the build phase, the focus should be on completing the facility, getting the C team in place. And this was a question which came up as well, and managing early transitions. If you think about the operate phase wherein you are running the GCC, it is all about execution. Are you able to hire and onboard people on time? Is your infrastructure ready? Are you staying compliant? These are the questions which matter the most, right? And then you have the dreadful transfer phase, right? I mean, I know we have all heard stories around how sometimes the enterprise are not ready to take a transfer, or sometimes the provider is not willing to do it. But essentially, transfer is a true test of how the model has been built. The smoother the handover and the lower the attrition, the stronger the foundation which has been laid out, right? And in a lot of deals, we are seeing assist as well. So wherein even when the transfer has taken place, the provider is still supporting the buyer or the enterprise, right? Now, this can be consulting, this can be scaling up, this can be stabilizing or performance management as well, right? The important thing is both sides need to agree on these measures upfront, right? These need to be aligned upfront, which ensures that A, everyone is aligned, everything is agreeable, focused, and you know who is accountable, right? Now, which brings us to the next section around what pitfalls you need to avoid if you are an enterprise or a provider, right? As we see on the next slide, right? If you are an enterprise, if you're a buyer, right? Once the success metrics are placed, the biggest question you would have is choosing the right partner, right? Selecting the right partner is often the make or break factor in a GC setup. By the way, it is not about who has the biggest brand, right? It is about who truly understands your goals, who is flexible along the journey, right? You should look at experience. Has the provider done similar work successfully before or not? Check the strength or capabilities of the personnel they'll be deploying. Do they have the right leadership? Do they have the right talent depth to manage both strategy and operations, right? Of course, capabilities matter, right? So their strengths should align with what you actually need, not just what they can offer, right? What is their transition approach? Can they manage risks and integrate teams smoothly, right? Do they have the right infrastructure and tools which can get you running quickly, right? And also evaluate their flexibility. The best partners can adapt engagement models as your needs evolve, because as you start on the journey, things will change. There will be changes in leadership, there will be changes in environment. I mean, we are getting a lot of questions around how agentic will impact GCC setups, how they'll impact GCC scale-ups, right? At the end, you need to keep in mind that the right partner is not just a vendor. It is like an extension of your team. And they need to help you scale up confidently. Again, one of the and as we see in the next slide, right? Even when you have a strong partner, there are still few mistakes which can derail the setup journey, right? So, for example, there are some traps which you need to keep in mind. The first one is underestimating the complexity of selecting and contracting the right provider. Often looks simpler on paper, but aligning strategy, scope, and risk can take time and care, right? The second is we often see enterprises bringing in external help too late. Once they are down in the weeds, they're struggling, then only they start involving. And sometimes it is too late as well, right? Sometimes some of the key decisions are already locked in, and which limits flexibility which you have at that time. By the way, this is controversial, I'll still say it. Pushing down prices too hard can also backfire. When your partner is not making money, it will reduce the level of commitment or quality which they will put in the program, right? And the last one is lack of clear communication or pure communication as well. It can undo months of work, right? You need to have shared understanding with your provider partner on what success looks like and how it will be tracked, right? I mean, if you are able to avoid these pitfalls, it will keep the setup on track and it will help you build a
I like to
partnership.
add one more, Akshay. I like to add
Yeah.
one more. Getting the wrong advisors in place. In fact, in a very recent situation, I came to know that one of the sourcing advisors who are involved with a large bank, they are advising right now in a BOT setup. They are saying to that bank that go ahead and set up a separate entity that we will do the setup for you, right? So in effect, by cannibalizing on their own advisory revenue, they're trying to milk down in the downstream revenue of setting up that entity and suggesting that set up two offices, set up operations and technology separately. So all this kind of wrong advisory, what would eventually happen is a lot of buyers may end up setting up the wrong culture in the organization, right? 3 years from now, those same set of buyers may come back to the market and ask, how do I sell off the GCC now? Right now they're setting it up. Tomorrow they may ask, how do I sell it off if they don't get the right advice, if they don't get the right solution in place. So that's another pitfall which is not mentioned here that I wanted to add to this.
Sure. Sachin, why don't you also cover what our provider folks should also avoid at all costs?
Sure, absolutely. So providers have more to lose than buyers, right? In terms of, because again, we have been having these questions, it cannibalizing my outsourcing revenue. How do I still kind of keep growing? And especially in a market where it's just not the legacy SIs, but their competition is also from specialists in the market, right? So I think the key pitfall that providers need to kind of think of and avoid at all costs is, first of all, having people with generic sourcing credentials, people who today do technology or business process outsourcing, to tomorrow do the solutioning for GCCs or planning for it, is the first wrong step. We have seen some of the providers do setting up their own GCC COEs, right? But we still see solution leads, we still see GCC practice heads who are still people who used to do 2 months ago just normal account management for their outsourcing engagement. So that's number one no-go area. Second is not presenting relevant case references, right? That there have been so many situations when seemingly people would have won the deal, ended up losing the entire deal just because they didn't have the right case references around that, right? Then we also see a lot of times where conservative service providers, what they end up doing is they keep all their solution deal sweeteners towards the last end of the exercise as a negotiation tactic. I think what I've realized is if you don't even go to the next stage, there is nothing to negotiate on, right? So if you have something to add as a value, do it right now, day one. Downplaying the culture of the organization, thinking, that everything works. We have seen so many funny responses coming out in deal orals where people just say people in India get hired for only compensation, right? So those kind of responses which do not resonate well with the buyer culture, especially those who are looking for hiring because of talent, are the strict no-goes. Similarly, lack of early visibility into what provider is wanting to do. Are they eventually going to transfer? Do they have that capability to do it? And lastly, it's about, again, I said it earlier, but there are so many deals out there. There are many actually GCCs out there which had intent to transfer, let's say 2 years, 3 years down the line, especially in BOT, but they have not done that even after 5 years. So providers should not do it. It does not go well long term for them. So these are the 6 pitfalls at least I can think of. Okay, so on next, we are at the end of the content. We are done through it. We have a lot of minutes left. So first of all, I'll try to kind of bring the audience attention to Engage GCC GPS India event, right, which we are planning to hold on 13th of November. And this is an invite-only event, which means all the GCC GBS heads are being invited. If you think you also may want to attend it, do send us do click on the link, and then we can effectively come back to you on that one. So this is going to be a super exciting event because we are going to talk all things GCCs, all things GBS, what the relevant ones, and we have all the GCC heads coming in. Akshay, you want to talk anything about this event?
No, really excited about it. We had the last leg in Dallas 2 weeks ago. This is an inaugural event in India. Again, we expect over 200 GCC leaders as part of the event. So look forward to seeing you all there as well.
Great. Okay, let's go ahead. On the next page, we talk about, okay, this is more provider focused, but again, there are ways to win this area, ways to win in this space. There are different ways we support our client, our buyer clients, our provider clients. In case you're interested, do reach out to us. And with that, I'll kind of switch on to the Q&A part. I am seeing the chat. There are so many questions that are seemingly coming up, but we did receive a lot of questions offline as well. So I think we can go to those questions.
Sure. Achin, do you want to talk about, if you're an enterprise, why would you choose, let's say, BOT or assisted? I mean, why are these the best models, and what fits in what scenario?
I think it goes back to the page where we talked about the buyer favorability, right? We talked about if the client is looking for more management, more governance, hand-on to be done day one, then they may go for an assisted captive kind of a setup, right? But if they are more conservative in nature, if they are still probing that, do I want to do this day one? Or let's say, for example, if they want to have more of an OPEX spend in the initial year and later take on the GCC, then they go with a BOT kind of a setup. So that's where the engagement models start differing. Joint venture becomes slightly more complex, especially with the fact that in joint ventures, the taxation becomes altogether very different because there's a big tax implication to it. And usually joint ventures can become really dirty, right? So that's the one where we see least adoption, even though it's happening. That's the fact, right? But then it usually happens when you are building out a product that you go out to the market and commercially monetize together.
I mean, even in our experience, right? I mean, we often see enterprises start sometimes with joint ventures and eventually move to a BOT or an ABO, right?
Correct.
So
Correct.
we see that happen as well.
Yeah,
all
absolutely.
Right,
it happens all the time.
Ravneet, as you work closely with providers, right? I mean, often providers ask us, is this a game only being played by the large ones, or there is enough support which small providers can also provide to enterprises or buyers?
I think, Akshay, to say this is just a big players space will be completely wrong. We do see an entire spectrum of players, be it large SIs, large providers in the space, big fours, MBBs, and even more specialist, smaller players coming up in this space. And given that different enterprises are coming up with different needs, different maturity on the GCC journey, not everyone is looking for a big player. So to say that, hey, this is just a big player's playground, in my opinion, will not be the right thing. A lot of enterprises do look for, especially first time adopters or who do not understand the GCC model, or they themselves are small players, are looking for smaller providers because they believe they will understand their needs better. And thus small players, big fours, MBBs, everyone today is playing big in this market.
Right. And one question which often goes hand in hand, right? I mean, what can you do as a provider to support enterprise better? So again, we are seeing across segments, as you described, right, multiple segments. We are seeing providers becoming much more programmatic, which means setting up dedicated teams, sales teams, creating offerings specific to this market, hiring people who understand the space, right? Hiring erstwhile GCC leaders for that matter, creating the right motivation within the broader organization so that all the provider resources have the best interests of GCC's enterprise in mind. Right? These are some of these levers which multiple providers are pulling to actually become much more suited to serve enterprise in this space. All right, great. Let's maybe take one or two more questions. Let's talk about, let's say, what are the top 5 things to keep in mind for someone setting up GC for the first time? Achin, do you want to take this one?
Okay, so top 5 things to keep in mind when
while setting up a GCC from an enterprise perspective.
while setting up a GCC. Again, some network issue at my end. Just want to make sure. I think first of all, I'll go back to the financial outlay when preparing a business case. If you want to do more like a capex spending versus an opex spending, because see, ultimately, if you don't do upfront capex, you will do more of an opex, right? So how you want to kind of have your balance sheet look is very important. Second, the whole intent of doing the GCC, why are you wanted to do it, right? I mean, I've seen previously, again, back in 2010s, a lot of it was driven by cost arbitrage and shared service functions to be delivered at scale. If you think today, a lot of GCCs that are getting set up is just because of access of talent, the sheer number of scale that they get access to in terms of from locations such as India, right? So having the right intent, having the right desire is the most important factor. I do know for a fact that a lot of GCC setups that are happening is in FOMO mode, which is fear of missing out, because my neighborhood bank or insurance firm or CPG firm is doing it, so I should also go and do it. Is one of the things that we see a lot of enterprise clients are grappling with. I think that's a strict no-go. Then if you think about third area of things to keep in mind, I think it's about the risk appetite, right? I think GCCs fail. That's a reality, right? There are so many examples out there. The thing that you can do as an enterprise client is to prepare for how not to fail, right? What all you need to do. And part of it is to kind of get the right partner, right advisor in the room, right? I know a lot of enterprise may save costs today, but it's going to harm them in the long term tomorrow. Big one, right? Then if you think about other factors that should be kept in mind is how will you set up the overall culture and how will you drive adoption, right? Because one of the other reasons GCCs fail is they are unable, a lot of time headquarters is not able to drive adoption from those locations. So that becomes a very important criteria as well. Again, a lot of it, but that's where here we are.
All right. Okay, so that's it from our side. I think we can close the webinar now. By the way, thank you everyone for tuning in. As we discussed, the slides and the recording will be available. The link will be sent in few days. It was great having you all. And in case you have any questions, just reach out to us. Our emails are listed on the page. Ajit, anything else you want to say before we close?
No.
No. All right. Perfect. Right. Thank you, everyone. And have a good day.
All right. Thank you all.